Investing basics. What are bonds? Bonds are IOUs issued by governments, companies, or other organizations wishing to raise money to fund growth or restructure debt. They are bought by investors such as banks, insurance companies, fund managers, and individual investors who receive interest payments in return for the loan of their cash. The issuer is the body borrowing the money. The coupon is the rate of interest the issuer promises to pay the lender. The maturity is the date at which the borrower repays the lender in full. An issuer wanting to borrow £100 million will typically issue 100 million bonds at par, 100p. The coupon is set at the point of issue and the agreed percentage is paid each year, for the duration of the loan. At the end of the term, each bond is redeemed at par. Prices quoted in the secondary market are relative to that starting and finishing value. Most bonds are senior debt, meaning the holder has a claim on a company's assets ahead of its shareholders. Types of bonds. Gilts. Bonds issued by the UK government to finance public spending. Rated as AAA, gilts are effectively a risk-free investment. Prices vary from day to day based on the outlook for interest rates. Investors can be sure that interest payments will be made, and that the loan will be repaid in full at maturity. The duration of gilts vary. Private investors favour maturities between 2 and 10 years. The government may sometimes repay the debt early if conditions are favourable. Index-linked gilts. Rather than a fixed coupon and redemption, payments are linked to the UK Retail Prices Index, RPI. A useful hedge in times of inflation. Perpetual gilts. No set maturity date and repaid when the government chooses. Prices are more volatile and the investor depends upon the market to recoup his funds. Corporate bonds. Issued by lenders ranging from foreign governments to medium-sized companies. Prices reflect market expectations for interest rates and the creditworthiness of the issuer. Negative sentiment around a company, and therefore an increased chance it may default, will see the price of the bond fall. Other variants include floating rate notes, convertibles, subordinated and retail bonds. Bonds have a launch, in the same way that there is an IPO when a company floats on the stock exchange. This is the primary market when bonds are sold to investors via an investment bank or broker. Bonds in issue are then traded between one institution and another, rather than via an exchange. The global market in bonds is enormous, double the world's combined stock market valuation, with wide variety in terms of currency, coupon, duration, and a range of other factors. The size of the coupon indicates the level of risk attached to a particular loan, i.e., the risk that the borrower will not repay the loan. Ratings help investors to navigate and understand this risk, ranging from gilts to junk bonds. DIY investors would do well not to stray from safer, investment-grade bonds. See DIYinvestor.net for much more information.